Today, the market is waking up to a sharper bet on real-world goods as Kalshi doubles down on commodities and unveils a dedicated hub. Traders are watching a practical shift from pure event contracts to price-driven risk management with tangible assets. In a volatile world, a centralized platform linking weather risk, supply chain factors, and physical metal flows could change liquidity, transparency, and hedging horizons. Regulators, brokers, and pension funds are asking how the new hub accelerates price discovery while keeping costs low and settlements secure. The stakes feel unusually tangible right now. Investors crave clarity amid policy shifts and shifting commodity cycles. Kalshi is broadening its footprint by turning commodity speculation and risk transfer into a more integrated ecosystem. The firm announces a centralized hub designed to house contracts tied to metals, energy, agriculture, and weather-linked indices, with tighter settlement rails and clearer margin structures. Think of it as a trading portal that sits alongside futures exchanges, providing transparent pricing and faster onboarding for retail and institution investors. The move signals a pivot from episodic event markets to continuous price discovery, where real-time data from supply chains, inventory levels, and shipping routes feed contracts as they mature. If scalable, the hub could lower trading friction and widen participation. To understand this shift, you stand back and recall how risk marketplaces evolved. Kalshi emerged from the idea that forecasts can be traded like assets, inspired by prediction markets that tracked outcomes from elections to weather events. Commodity markets, by contrast, have long rewarded physical hedges and long-only positions, but volatility and geopolitical shocks have driven demand for flexible access. The proposed hub mirrors how major platforms like CME and Nasdaq digital assets add suites of linked products, yet it centers on accessible contracts tied to real-world inputs rather than purely speculative bets. Investors have waited for clarity on settlement standards and regulatory guardrails. Markets are absorbing Kalshi's expansion as desks test how a hub will alter liquidity, spreads, and price formation in commodity contracts. Early chatter centers on tighter bid ask differentials because more participants enter the same venue, potentially improving price discovery during volatile sessions. Traders compare this to the arrival of a new exchange-traded fund in a crowded sector, except here the contracts anchor to physical inputs like copper inventories, oil forward curves, or rain in crop belts. If onboarding scales, banks and asset managers may route more capital through Kalshi rather than disparate venue routes, reshaping flow patterns. The effect could be smaller spreads. Who benefits from a dedicated commodity hub? Large energy companies, mining majors, and agricultural traders stand to gain clearer hedging paths and more reliable pricing signals. Banks underwriting risk may deploy smaller capital per contract with faster latency, while wealth managers could offer clients diversified access to commodity exposures without complex futures accounts. Retail traders, often pushed to opaque venues, may find standardized products and better education through Kalshi ledgers. Shipping firms, refineries, and storage operators could align schedules with on-chain data feeds. The ecosystem ripples into insurers and exchange revenues as volumes climb. Policy updates and settlement integrity will matter. Macro forces loom over this rollout just as a storm shapes a harbor. Inflation dynamics, central bank policy, and a tug-of-war between risk appetite and capital discipline shape who rushes into new contracts. Geopolitics add another layer. Sanctions, supply chain diversifications, and a push toward commodity independence influence pricing discipline. A dedicated hub promises resilience by pooling data and standardizing settlement, but it also concentrates counterparty risk in one venue. As energy, metals, and agriculture cycles shift with weather patterns and inventory levels, investors calibrate risk using scenario analysis rather than gut feeling. Policy clarity and cyber resilience emerge as additional anchors. Smart money tips its hand in a cautious chorus. Institutions quietly test liquidity by stepping into Kalshi's platform with modest position sizes, using risk budgets to gauge execution quality and settlement reliability. Hedge funds may view the hub as a way to harvest cross-asset correlations, aligning commodity exposures with equities or currencies. Family offices and sovereign wealth funds could embrace regulated access rather than bespoke over-the-counter deals. Retail platforms observe higher user signups, more questions about margin and due diligence, and a growing appetite for educational content that demystifies how weather and inventory data move prices. The narrative is still forming around latency and trust. Yet there is a bear case that deserves attention. Concentrating a growing slice of risk activity in one hub could amplify systemic shock if a single provider experiences outages, cyber breaches, or liquidity gaps during stressed markets. Regulatory overreach or misaligned margin needs might throttle onboarding or raise capital costs. The hub could tempt complacency, eroding the discipline of diversification as participants rely on another trusted venue. Commodity markets remain exposed to weather shocks, geopolitical flare-ups, and sudden demand shifts that defy even robust data models, reminding us that complexity travels with leverage. Regulatory clarity, stress testing, and transparent governance could mitigate these risks. For retail investors, the path is to stay disciplined and educated. Start with a clear budget for commodity exposure and avoid chasing momentum on one platform alone. Use simple position sizing, test with paper trades, and seek educational resources on how weather, inventory, and macro data drive prices in hub-linked contracts. Demand transparency from the provider about settlement timelines, counterparty risk, and fee structures. Diversify across assets rather than succumbing to a single hub narrative. Finally, watch for real-world signals such as outage reports, regulatory updates, and quarterly contract rollovers that can flip sentiment. Patience and verified data are your allies. Looking ahead, Kalshi's Commodities Hub could recalibrate hedging choices for manufacturers, farmers, utilities, and funds seeking balanced exposure. If the platform delivers on liquidity, settlement speed, and data fidelity, it may unlock participation from producers and regional traders who feel edged out by older venues. The signal is not a guarantee, but a bet on modernization that aligns risk management with real-world inputs. Regulators will test the framework, while competitors watch the response. The horizon favors adaptable investors who blend data, discipline, and strategic patience for a diversified commodity portfolio. If you found this valuable, subscribe to The Commodity Brief for weekly insights on alternative assets and commodities.